The cryptocurrency market has witnessed dramatic changes over the past year, and one digital asset in particular has been at the center of a remarkable transformation. XRP, the token used by Ripple for cross-border payments, is experiencing what analysts are calling a structural shift that could reshape its market dynamics in ways we haven't seen in nearly a decade. According to data from 21 Shares published in early 2026, the amount of XRP held on centralized exchanges has plummeted to approximately 1.7 billion tokens. This represents the lowest level in 7 years. To put that in perspective, major exchanges like Binance and Upbit held around 4 billion XRP as recently as early 2025. In just 12 months, more than half of the readily tradable supply has been pulled off exchanges. CryptoQuant data confirms this trend, showing exchange reserves have dropped by roughly 45% in just 60 days during late 2025. This isn't just traders holding their tokens. What we're witnessing is a fundamental change in where XRP is being stored and who controls it. Tokens are moving from exchanges where they can be sold instantly into institutional custody, regulated vehicles, and long-term storage. This shift matters because it directly impacts how easily the asset can be bought or sold, and it's happening at the same time that new buyers are entering the market through regulated products. The big story from late 2025 was the approval and launch of spot XRP exchange-traded funds in the United States. After years of regulatory uncertainty, the Securities and Exchange Commission began approving XRP ETFs in November 2025. Bitwise launched its XRP ETF on November 20th, trading under the ticker XRP on the New York Stock Exchange. Canary Capital, Franklin Templeton, 21 Shares, Grayscale, and CoinShares all launched their own XRP ETFs around the same time. According to So Value, these funds collectively accumulated over $1 billion in assets under management within their first month of trading. What makes these ETF launches particularly significant is their performance. According to a 21 Shares report, XRP ETFs experienced 43 consecutive days of net inflows with 0 outflow days during their initial trading period. This type of sticky institutional demand is unusual for newly launched crypto products. For comparison, when Bitcoin and Ethereum ETFs launched, they experienced more volatile flow patterns. The sustained demand for XRP ETFs suggests institutional investors view this as a long-term allocation rather than a short-term trade. But where did these billions of dollars in ETF demand come from? They came from the same exchanges that are now showing depleted reserves. When authorized participants create new ETF shares, they must source the underlying XRP tokens from somewhere. They buy them on exchanges and transfer them into institutional custody. Once in custody for an ETF, those tokens are no longer available for retail traders to purchase. According to Bean Crypto, institutional custody providers now hold over 400 million XRP in regulated vaults for these ETF products alone. This creates what market analysts call a supply shock setup. You have declining liquid supply on one side and increasing institutional demand on the other. The gap between these two forces can create price volatility when a catalyst emerges. But this isn't speculation, it's basic market mechanics. When fewer tokens are available to buy and more buyers compete for them, prices typically adjust upward to find equilibrium. Understanding this dynamic requires looking back at what happened to XRP over the past 5 years. In December 2020, the Securities and Exchange Commission sued Ripple Labs, alleging that XRP was an unregistered security. This lawsuit cast a shadow over XRP for nearly 5 years. Major U.S. exchanges delisted the token. Institutional investors stayed away. Retail holders endured years of uncertainty while the case wound through federal court. The lawsuit finally concluded in August 2025. According to official SEC litigation releases, Ripple agreed to pay a $125 million civil penalty, and both the SEC and Ripple dropped their respective appeals in the Second Circuit Court of Appeals. The settlement left intact a crucial 2023 court ruling that found XRP is not a security when sold on public exchanges to retail buyers. Only certain institutional sales were deemed securities offerings. This regulatory clarity unlocked the door for regulated products like ETFs. Within weeks of the settlement, asset managers began filing applications. The SEC, under new leadership in 2025, moved quickly to approve them. What had been impossible for years suddenly became reality in a matter of months. Now let's talk about the Ripple escrow system, because this is often misunderstood. Ripple established an escrow mechanism in 2017 where up to 1 billion XRP is automatically released from time-locked contracts each month. This was designed to create supply predictability. On January 1st, 2026, exactly 1 billion XRP was unlocked from escrow, valued at approximately $1.84 billion at the time of release. However, according to blockchain data reported by Byte.ru and other analytics firms, Ripple has historically relocked between 60 and 80% of each monthly unlock into new escrow contracts. In December 2025, roughly 70% of the unlocked XRP was returned to escrow, leaving only about 300 million tokens potentially available. This disciplined approach prevents sudden supply shocks and demonstrates that monthly unlocks don't automatically translate into selling pressure. The escrow system is mechanical, not emotional. Its protocol enforced transparency. Observers can track exactly how many tokens are unlocked and how many are relocked. This predictability has allowed the market to absorb these events without panic over the past 8 years. Another piece of this puzzle is Ripple's stablecoin, RLUSD. Launched in December 2024, RLUSD is a dollar-pegged stablecoin issued under a New York Department of Financial Services trust charter. According to CoinMarketCap data from early February 2026, RLUSD has reached a market capitalization of approximately $1.5 billion. This makes it the third largest U.S. regulated stablecoin positioned for compliance with proposed federal frameworks. RLUSD matters for XRP because it creates complementary utility on the XRP ledger. While RLUSD provides stability for transactions, XRP serves as the native asset for network fees and can act as a bridge currency in cross-border payments. As reported by You Today, Ripple has integrated RLUSD into corporate partnerships with institutions like MasterCard and WebBank for credit card settlement on the XRP ledger. The stablecoin has also been adopted by BlackRock as collateral for its tokenized treasury fund, according to reports from December 2025. When RLUSD transactions occur on the XRP ledger, they burn tiny amounts of XRP as network fees. This creates a deflationary mechanism where increased network activity leads to increased XRP burns. While individual transaction fees are minuscule, measured in fractions of a cent, high-frequency institutional usage could compound over time. This isn't speculation, it's how the XRP ledger protocol functions. The broader narrative around XRP involves its role in the tokenization of real-world assets. Major financial institutions are exploring blockchain-based settlement for everything from U.S. treasuries to corporate debt. According to 21 Shares analysis, the XRP ledger is positioning itself as a settlement layer for these tokenized assets. While specific adoption figures are difficult to verify, the trend toward tokenization in traditional finance is well documented and accelerating. Ripple CEO Brad Garlinghouse has publicly stated that the company aims to capture a significant portion of global payment flows, particularly targeting inefficiencies in the SWIFT network, which handles trillions of dollars annually in cross-border transactions. Whether XRP achieves this level of adoption remains to be seen, but the infrastructure is being built and tested through partnerships with financial institutions worldwide. One regulatory development to watch is the Digital Asset Market Clarity Act, commonly called the Clarity Act. This legislation passed the U.S. House of Representatives in July 2025 with bipartisan support. According to the Senate Banking Committee, the Clarity Act would establish clear jurisdictional boundaries between the SEC and the Commodity Futures Trading Commission for digital assets. It would define which assets are securities and which are commodities, providing the regulatory framework that the industry has sought for years. As of early February 2026, the Clarity Act is still pending in the Senate. According to reports from Baker McKenzie and other legal observers, the Senate Banking Committee postponed a scheduled markup in mid-January 2026 to address concerns from industry participants and preserve bipartisan negotiations. The Senate Agriculture Committee scheduled its own markup for late January. White House crypto policy advisors have described the Clarity Act as a critical priority, but the legislation faces procedural hurdles and must clear both committees before a full Senate vote. If passed, the Clarity Act could remove remaining regulatory uncertainty and potentially encourage additional institutional capital to enter digital asset markets, including XRP. However, passage is not guaranteed, and the timeline remains uncertain as of this recording. So what does all of this mean for XRP's price? Analysts at 21 Shares have published price scenarios for 2026. Their base case projects XRP could reach $2.45, assigned a 50% probability. A bull case scenario envisions $2.69 with 30% probability, driven by institutional tokenization scaling and tighter liquid supply. Their bear case sees $1.60 with a negative 16% probability if adoption stagnates and capital rotates away. As of early February 2026, XRP is trading around $1.32, according to CoinMarketCap. The token is down significantly from its recent highs, reflecting broader cryptocurrency market weakness. Whether exchange reserves at 7-year lows will lead to a supply-driven price increase depends on whether demand materializes and whether regulatory clarity continues to improve. Some market observers draw comparisons to past supply squeezes in other assets. The Hunt brothers' attempted corner of the silver market in 1980 is sometimes cited as an example of what happens when liquid supply disappears. However, such comparisons should be treated with caution. Every market has unique characteristics, and historical parallels have limits. What we can say with confidence is that the data shows a clear trend. Exchange reserves are declining. Institutional custody is increasing. Regulated investment vehicles are accumulating. Regulatory clarity is improving. Ripple is building enterprise partnerships. These are verifiable facts, not speculation. The cryptocurrency market operates on supply and demand like any other market. When supply available for trading decreases and demand from institutional buyers increases, economic theory suggests prices should adjust upward to reach equilibrium. Whether XRP experiences such an adjustment in 2026 depends on factors that cannot be predicted with certainty, including overall market sentiment, regulatory developments, the success of institutional adoption, and macroeconomic conditions. Investors should understand that cryptocurrency markets remain highly volatile and speculative. Past performance does not indicate future results. Anyone considering exposure to XRP or any digital asset should conduct thorough research, understand the risks, and only invest what they can afford to lose. The regulatory landscape, while improving, still contains uncertainties. Technology adoption timelines are notoriously difficult to predict. Market conditions can change rapidly. What separates the current XRP situation from previous periods is the convergence of multiple factors: regulatory clarity following the SEC settlement, institutional access through ETFs, declining exchange supply, a functioning stablecoin creating network utility, enterprise partnerships in traditional finance, legislative progress toward comprehensive digital asset regulation. These elements together create a different environment than XRP has operated in before. The next several months will reveal whether institutional demand continues, whether the Clarity Act passes, whether RLUSD adoption accelerates, and whether exchange reserves continue declining or stabilize. These are the metrics worth watching for anyone trying to understand where XRP goes from here. The market doesn't reward predictions. It rewards accurate assessment of data and patient positioning based on probability-weighted outcomes. Whether you own XRP or are considering it, the imperative is the same. Focus on verified information. Track measurable developments. Understand the structure beneath the price action. Because in markets characterized by volatility and emotion, calm analysis based on facts provides the only reliable compass. The transformation of XRP from a token shadowed by litigation to an asset with regulated institutional products and exchange reserves at 7-year lows has occurred in less than 18 months. What happens next will be determined by adoption rates, regulatory outcomes, and market dynamics that are still unfolding. Stay informed, stay rational, and remember that in digital asset markets, the biggest moves often happen when the majority isn't paying attention.